So now let's turn our attention to fixed costs. And we'll show how those are calculated differently than what we just did for variable cost variances. Let's turn to the same example, but with some additional information added on. So for the coming month, we know the following about fixed costs and the budget for them. The fixed cost is budgeted to be $16,625. And as we learned for variable overhead, the firm has identified the cost driver as machine hours, and we're supposed to use, in a standard world, 1 machine hour per unit produced. At the end of the accounting period, we collect the actual information. And that is that we have actually spent in fixed costs $16,900. We actually produced 4,250 units, and our machine hours used was 4,700. So in terms of developing a framework for fixed costs, let's think about what is relevant from our variable cost framework. In that one, we had a static budget that was comprised of standard price, standard input, and standard output. We had a flexible budget in which everything was standard except our output. We had a third column, standard price column, where the only standard piece of information that we included in that calculation was the price itself. Everything else was on actual terms. And then, of course, we had a completely actual column. Actual price, actual input, and actual output. Now, we talked about the spending variance, the efficiency variance, and the activity variance for variable costs. And the activity variance was due to the fact that we produced a different amount than we thought we were going to produce when it came to the outputs, our units of production. When we think about fixed costs, by definition, fixed costs don't fluctuate with units of production, assuming we're on the same relevant range. So this variance, the activity variance for fixed costs, doesn't really apply logically. So in essence, we can ignore for fixed costs the notion of a flex budget column. Exceptions will be noted later, but for the purposes of thinking about spending, efficiency, and activity variances for fixed costs, there really is no activity variance that we can attribute an overall difference to. Now, in terms of thinking about the flexible budget versus the standard price column, and we calculate the efficiency variance, that had to do with fluctuations in the actual input compared to the standard input per our unit of output. And again, for fixed costs, that doesn't really actually create a variance. It is not logical to attribute some usage of an input to the fixed cost because different levels of activity, whether you're talking about inputs or outputs, don't really drive fixed costs. So in essence, we can ignore the standard price column as well for fixed costs. Now, in terms of price, that does make sense to think about at a fixed cost level. You can think about a rent for an apartment or a home, and during the year you think that you're going to spend $1,000 per month on that rent. But suppose that the landlord raises the rent during the second half of the year. You ended up paying a different price in actual terms than you thought you were going to pay. So of course the price for fixed costs can vary over an accounting period. And that's what we will attribute all of our fixed cost variances to. The fact that the price of those fixed costs was different than what we had budgeted, expected, and created as a standard. So in terms of our example, it's much simpler than a variable cost variance is concerned. We were told that we would budget $16,625 for our fixed costs for the month. The given information suggested that we actually spent $16,900. The difference between those two is $275. And some managers talk about that cost being a static budget variance because that's the only variance that's applicable to fixed costs at this point. And other people just call this a fixed cost spending variance because the price was different than what you thought. By the way, classifying this as favorable or unfavorable would lead me to label this an unfavorable variance. And the reason is because we actually spent more than we thought. Our costs were actually higher. Therefore, all else equal, our net income would be lower, yielding an unfavorable variance.